The cloud. All right, guys. Hey, good morning, everybody. Today we're going to be talking, and it's very, very timely type of topic. We're going to be talking about taxes. Okay. Ultimately, what we want is we all got to pay our fair share, but we should not pay one penny more. And there's a correct way to do it. There's the wrong way to do it where you're kind of playing with fire. And then there is the way of doing it where you didn't know what you could take advantage of. So, with that, I have Alan. Alan is the guy that I go to, and I call him my tax strategist. So, I go to him because I'm always trying to figure out how to minimize the amount of taxes that I need to pay. I don't want to pay anything more, but I want to do it the legal way, the right way, just in case I have an audit. I don't want to worry about playing with fire. So that's what Alan's going to help us out with here, guys. He knows, he's been working with me. He knows the industry, the insurance industry, knows how the problems that we have to deal with. So, Alan, man, thank you so much, man. Appreciate you being on here.
Louise, good morning. Thanks for having me on. Let me pop my screen up so I can kind of share a few things with y'all.
Okay. And I hope you can share. Let's see here. Oh, there you go. Great. And guys, do me a favor. Since we are doing this webinar style, put your questions, any questions you have. We'll have a little Q&A towards the end, but post them on the chat, and when Alan gets done, we'll ask every single question.
For anything else, just a little introduction, guys. Alan Crosswell. I'm a tax strategist and preparer for Torres Advisory and Consulting Services in San Antonio, Texas. I do have to have some disclaimers just for liability reasons. Everything presented here is generic, not specific information for you or any businesses. We are not liable for anything you do or don't do with this knowledge. But first things, everyone here is probably going to assume, okay, I work for an insurance company. I'm an employee, just like every other job I've had. Where insurance agents really tend to mess up, in my experience through Luis and some of his workers now that I've worked with, is they act like an employee when you are not. That's where it comes to difference in taxation. People don't think of it this way. When you're an insurance agent, you are self-employed. The IRS does not see you any different than they see a company, a brick and mortar shop, or a large corporation. Where this is different is that you are in charge and responsible for paying all of your taxes directly to the IRS. Now you might say, that's already how I work now at my previous job. I'm a W-2 employee. At the end of the year, if I owe taxes, I pay it to the IRS. That's not how it really is. When you're a regular employee, you have a middleman, the company that employs you. They are in charge not only for collecting and dispersing your taxes to the IRS, but they are in charge for half of your payroll taxes, which that is the biggest thing that self-employed individuals don't think about. And you'll see it. Some of you, this might be your first year doing insurance sales. And you're like, hey, I made 90K. I normally before when I made 90, I owed 10 grand in taxes total. All of a sudden tax time comes and you owe 17,000. That's the other half of payroll taxes you're not considering. So for every dollar you make now, there's an extra 7.5% that you're paying that no one else covers for you. Which, Luis, I know you can attest to the fact that that is the biggest hit that affects people in this industry.
100%. And here's my little tip that I will throw in is, guys, if you make $1, just remember this, that entire dollar is not yours. All right. The man wants his portion of your dollar. So that's what we're trying to do here is figure out, all right, how can we minimize that portion that he takes? So yes, 100%. Most of us are 1099. We receive the full dollar from the insurance company that we represent when we sell a policy, and we get paid a commission. But remember, guys, you've got to be super disciplined. I'm going to share one story, and I'll let you continue, Alan. But one story I had when I was new in business, coming off ex-military, where you're a W-2, coming off being a teacher, W-2, I didn't know any better. So I was receiving my money and was doing my thing. Well, tax time came around and I owed some money and I didn't have it. So the one and only time in my life, other than being a kid, where I had to go to my parents and say, hey, I need to borrow some money to pay my taxes. Luckily, when I was starting off, it really wasn't all that much, but still a super uncomfortable scenario to be in. So I would say tip number one, here's pro tip number one, is always you should have two accounts. You go open up two business accounts at the bank. Number one is your account where you have all your commissions being deposited. And I think the second one that you need to have is if you get $1, you need to move a portion of that dollar to your other account that you're going to hold in escrow to pay either your quarterly or your annual taxes, where you move a portion of that dollar away. That way, because bottom line is the man wants his money, he's going to get it one way or the other. So you might as well do it every time you get a commission check. Move that money over. All right, Alan, go ahead, bud.
And on the lines of what Luis is saying there, the average self-employed individual in the US will pay taxes at roughly 30%. So the safe rule is moving every time you get a 1099 in or a check in, moving 30% of that to that tax account. Which basically comes from you're paying 15% of payroll taxes to pay your side and the employer side, which is yourself. You are your own employer, as well as federal income taxes, which is roughly for most people at least 30%. And as Luis will tell you, once you get more and more successful in the industry, that only goes up. Now you'll ask, what are some things I can do to be taxed differently or elect between these things? So the first thing is structures. A lot of us have heard, I'm sure, of sole proprietorship or a sole prop and limited liability corporations, LLCs. Now, neither of these are a tax structure. They can have a tax structure within them, but they are just legal structures. The main thing one of these is going to provide versus the other is legal protection. When you're a sole prop, that is literally what it says. A sole proprietorship, that is just you. The government, lawyers, judges look at that like that's you. Meaning, anything you mess up, anything that you are liable for, you are personally liable for. You mess up something on the insurance, you're driving to a meeting, it's technically now a commercial event, you crash and hit someone. You are liable for all of those events. On a limited liability corporation, your company is liable, meaning the main things at risk are what's held within your company. When Luis talks about having an account where commissions come into and then a tax account, those are by the business. If you have a vehicle under business, things like that, your home, your personal investment accounts, your cars at home, none of that should be liable. Now, where this gets to the second step is the tax structures you can have within those things, which Schedule C. This is the simplest way and the way most people start when they get into insurance sales or other type of commission-based work. A Schedule C is just another line item on your personal tax return where self-employed income goes. Now, Schedule C does allow you to write off direct expenses if you have to pay softwares, education costs, things like that. Where Schedule C kind of limits you is you can't write off any payroll taxes, investing for the business, things like that. That's where the next two structures really come into play. And for those of you that had accounting classes, if you were in business school or something like that, you'll remember S corporations and C corporations. These are truly now where you are taxed like a company. Schedule C, you're viewed and have the liability as a company, but you're taxed like a person. Where S corporations and C corporations get a big advantage is you can write off half of all payroll taxes if you invest, for say. And you right now, when you have a 401k and your employer matches your 401k, they get to write off that portion that they match for you. Likewise here, if you are now a S Corp or a C Corp and you have a solo 401k or a self-employed pension within that, you get to write off the entirety of that owner's contribution or company contribution. Which, Luis, if you don't mind me kind of speaking about your situation and things we've implemented.
Go right ahead.
With Luis, we implemented a self-employed pension. When you have your own company, be it a Schedule C, S Corp, or C Corp, you can deduct a portion of your income into an investment account called a self-employed pension. And that is a dollar for dollar write-off on your taxes. So come tax time, say you have a $200,000 net profit and you're going to owe $50,000, $6,000 in taxes. Well, all of a sudden you can put $50K into this investment account, write off dollar for dollar. Your taxable income is now $150,000. You can't do that, or at least not to the extent, when you're just a Schedule C. Now, where the main difference comes between S corporations and C corps, which nowadays you really do not see C corporations that often, is that a C corp is liable to double taxation. When you have a C corp, you pay taxes at 21%, which is the current corporate tax rate, on every dollar you make. That's just at the company level. Then if you want to take money out of that company, you take that as a dividend and you owe taxes on that. So we're really only seeing C Corps when you have either multiple partners within a business where they kind of want to have some separation in when they take money in or out. For instance, we decided to partner with some other agents and buy a book of business. They might form a C Corp, put money into it, buy this business, and not take money out of it for a year, 2 years, 3 years. So for 3 or 4 years, they get to grow that business and keep that low taxation. For most of you, really, these first two of Schedule C and S-Corp will be where you're going to fall to avoid that double taxation. Because if it's just you, there's no reason to pass off the tax into the future and then pay them again. Louise, is there anything you kind of want to touch on with those?
Well, the one question that I get a lot from agents is this confusion that you're talking about. So a lot of times they think a legal entity and a tax entity, they confuse those quite a bit. So they start thinking, well, I want to be taxed as an LLC. Well, an LLC really is just a legal umbrella to protect you. It doesn't really provide any specific taxes. These tax structures, whether you're a Schedule C, which is a sole prop, is that correct?
Yes.
And then you have your S Corp and C Corp. Do those make, those are tax structures. So you really got to start thinking, guys, in the sense of a legal structure and a tax structure. They're somewhat related, but they're really independent of each other. And different people handle those different entities. An attorney would handle more of your legal structure. They'll help you set up that LLC. Okay, and you can do it on your own, I guess. But ultimately, yes, you want to handle that with an attorney if depending on how complicated it is. And then this is where you get with a tax strategist, a CPA, a tax preparer to help you with one of these three scenarios. Now, Alan, are you going to talk about when an agent, when one of these makes more sense for an agent income wise?
Of course. So the main thing that's going to come down to is net income. Again, when we get our commissions in from for your insurance, say, you might see that you made $200,000 of income off those revenue. What really matters is after all expenses, deductions, things you can claim, what are you making? For most people, if you're netting less than $60,000 for the year, Schedule C is going to be your best option. And the reason being is when you have an S corporation, you now have a whole separate tax return, a whole separate reporting standard, quarterly reports you have to make, payments you have to make. The cost of running that could eat away a lot of the tax savings you'll get by being an S corp. To give you simple math, say you make $100,000 of net income. If you were a Schedule C, you're going to owe off the bat 15% of payroll taxes, so $15,000. Then you're going to fall into roughly a 18% tax bracket. So in total, you're going to pay about $2,000 on that. If you're an S corp, you get to write off half of those payroll taxes. Half of that 15 is $7,500. You just remove your tax bill from $32,000 to roughly $25,000. It's not going to cost you $7,000 to have an S corp return and some of that reporting. When you only make $60,000 and you're only going to lower that bill by $2,000 or $3,000, that can make it where it's almost a break even between the S corp and a C corp, right, and a Schedule C. Which, if you're not going to save money, for most of you, you don't want to have the hassle of an extra return and all these different things. The next thing that's going to change that also is if you have employees. A lot of you hopefully are going to have a long career in insurance. You might decide, hey, I want to have 4, 5, 6, 7 agents under me. Well, now you're going to start seeing that I have a bunch of taxes I'm paying, all these different structures. The S corporation is going to allow you to have more tax structures under that. If I have 6, 7, 8 employees, I'm going to offer them their 401k or their solo 401k, simple IRA. For all of those things, having the S corp is going to give you some more flexibility on how to write off those costs. Then the second big thing is once you get to the level of you're making $200,000, $300,000, $400,000 in this business, which is doable, obviously. With an S corp, you can choose to pay yourself what is called a reasonable salary, reasonable compensation. Which, if you can say, I am technically the CEO of this company and the market rate for that is $150,000. After that, anything you pay yourself out over that $150,000, you pay no payroll taxes on, only income. So for those people, that is huge, because if you were still a Schedule C at this point on 190, 200,000, you're paying 15% extra tax that you would not pay under the S corporation. So it really gets exponential as people make more and more. And for the C Corp, as you kind of touched before, it's very limited cases where you are going to need it, though on a C Corp, you never pay any payroll taxes. So the C Corp is really going to be for people who want to avoid, in general, having any level of payroll taxes because they have no other income. Because once they take that income out as a dividend from the C Corp, you only pay dividend tax rate, which for some people can be as low as 10% or as high as 20%. So for some people that are, say, retirees who just own the business, it's cheaper for them to take the dividend, pay dividend tax rate, and not have any payroll taxes.
Alan, a little confusing. And I get agents that are asking, hey, I don't want to pay payroll taxes. So the S Corp really is the only way you're trying to minimize the payroll taxes on yourself, not the employees. Is that correct? That's the whole game here.
It can go both ways, because for instance, if you have an S Corp and you give your employees a 401k, that reduces their taxable income. So you are going to reduce some of the taxes being held there. On both sides of it. They're going to reduce them and you're going to reduce them. Okay. That's kind of the main difference there.
Okay, got it. A little confusing, guys, but I will tell you this. One thing we're going to do, I'm an agent like you guys, and I'm also sometimes like, hey, which one is best for me? And I don't think that maybe there's a little rule of thumb, but it's going to be very specific to you. Now, at the very end, we will share Alan's contact information. If you want to connect with him one-on-one, where you share your personal data, he can help you set that up. I try as an insurance agent to stay in my insurance agent lane. I know enough to understand what tax pros are saying, but not enough to really make it happen for myself. So if some of this is a little fuzzy for you guys, like it still is for me, and it's not you, Alan, it's just I don't have a tax mind. Towards the end, guys, we will share his contact information. You can set up a one-on-one and then decide if you want to work with him. But Alan, correct me if I'm wrong, it doesn't matter as long as they're here in the U.S., you can help them out.
U.S. or Puerto Rico, which some of you might be, I'm not sure.
Okay.
And then one last thing I did want to touch on, since you were talking about confusion. The biggest thing I see, and specifically in insurance sales where people mess up, is when you're paying your taxes. Which the biggest thing, Luis, I'm sure you're aware of, is quarterly tax payments. Because in the US, we owe income tax technically every time we make income. If each month something comes in, you technically owe it right then and there. When you are a W-2, you don't feel it's that way because those taxes are being withheld from you on your paycheck. You're just seeing the net check that comes out. When you're self-employed, the biggest way to get caught in trouble is if you're not doing, first of all, what Luis said, putting a portion of that check into an account, portion it away, but then also each quarter, you have to make that payment to the IRS. If not, it doesn't matter how much you scorned away. You're going to pay penalties for that full year that you were behind, which for many of you, you're going to see this the first, second year that you're doing this self-employed type of work, is you're going to see tax owed $2,000 on your tax return. And then below that, you're going to see penalties and late fees, which even though you're paying by what you think is the tax deadline, you are used to April 15th being your deadline for everything. When you're a business, it's not. Each quarter is your deadline to pay that quarter's worth of taxes. And this is where I really urge people to work with a tax pro. If you had a simpler business that was, say, a more merchant type business where you have things you are buying and reselling, it's very simple for you to know what your actual profit is. You know what your cost to get it was, what your sale price was, and say if you had to drive or have a storefront. You can schedule pretty easily what that is each month or each quarter and know what to pay. When you're an insurance agent, you might not know that year, how am I going to deduct a vehicle? How much am I going to invest? What type of home office deductions am I going to have? So you might have quarters that you think you're netting X, and it's actually 10 or 20% above and below that. And those are the things that hiring out a tax pro, a tax pro CPA can take care of everything for you. And what it really allows is for you to mitigate your time better. Most of you, if you're intelligent people, you could figure out how to do especially your own personal taxes, but it might take you 50, 60 hours of the year. Instead, you can trade those 50 or 60 hours to pay a tax pro $400, $500, $600 to do this for you. And I'm sure most of you know that with 40 or 50 hours a week of work, you can generate a lot more than $500 or $600 worth of commissions. So it's really kind of utilizing your head, trading your time for money.
And if somebody uses a tax pro like yourself, the money that we pay you is also tax deductible.
Exactly, as a business.
Alan, what are the 4 quarterly dates that people need to pay their quarterly taxes?
So the 4 quarters is kind of weird because they run into separate years. Is April 15th, June 15th, October 15th, and then January 15th. Where that can look kind of complicated is because you pay your last quarter's taxes in the following year. And this is really just to give you time after your December books close to do your bookkeeping to figure out what you actually owe for that last quarter. And again, you can always pay these ahead of time. We do have some businesses that pay the entirety of their quarterly payments right at the beginning of the year. Or for some people, if they use that working capital, again, if some of you end up having employees and a work front, things like that, it might be worth it to you to have that working capital for longer, and you might make the entirely yearly quarterly payments in that last quarter.
Gotcha. And I would just tell you guys, you put that money away, it's just a good way to run your business. Just know you're never going to get away from the man. Man wants his money. And again, most of us work 3 months out of the year, and I hate it when I say this, Alan, but man, it just kind of, it makes it sting more. And I don't know why I say this, but you're at the bare minimum, you're going to work 3 months for the government. Okay. 9 months is yours, 3 months for the government. It's just the way it is. It's the beautiful country that we live in. So, guys, just make it happen. I do love all the questions that you guys are asking. Keep asking those questions. We'll have a Q&A here towards the end. But Alan, I'm going to jump into a quick one here, if you don't mind. What are some common deductions that you think agents don't take?
So 2 of the biggest things I see that people don't claim is marketing. So there's a lot of things that you might not consider to be marketing or customer relations that a lot of you do. It can be as simple as you're on LinkedIn trying to associate with other insurance agents or other clients. You are driving out to say you have a client that has a restaurant, and you're driving out to see them to onboard some of their, again, if some of you sell health insurance, onboard some of their clients, or to quote them for cars, liability, things like that. All that is an expensive marketing. Most people, all they do is they log mileage, which depending on where you live, might not be that much. Second thing is getting uniforms. That's marketing. Say you buy 10 shirts that have your logo, your company's name on it. All those are things that you can add on that people a lot of times just take it as a cost of doing business. Almost anything that you can tangibilize into being the pursuit of revenue is a write-off. And marketing is one of those biggest ones for insurance. It's going to mainly be that, home office, for some of you that don't reside fully at someone else's workplace, and a vehicle. Which vehicles are where you can have, especially once income gets higher and the vehicles are more and more expensive, is where you can have the most flexibility. For instance, with Luis, I know we've had this back and forth on multiple years deciding how to deduct a vehicle. Are we leasing this? Are we trying to do bonus depreciation? Which some of you, I'm sure most of you have heard of the 179 deduction. Or if you have a heavy truck, heavy machinery, the famous G-Wagon thing, you can depreciate 100% of a vehicle. Or for many of you, mileage instead. So purchasing those, and then the home office. When you're self-employed, you might not have a office that you drive to each day, but you have a house or an apartment. You get to proportionally deduct part of your rent or part of your mortgage, repairs. If you had your roof repaired and your office is 1/10 of your house, well, 1/10 of that roof is a business write-off. And then the last one I see almost everyone forget is health insurance. Health insurance, life insurance, dental, disability, which hopefully all are insurance agents, all of you should have. When you're self-employed, you get to write off the entirety of that. just like your employer would write off the entirety of their employer-sponsored plan for you. And fourth would be that investment. Sorry, go ahead. And the fourth would be investing, which again, hopefully most of you are either having IRAs or self-employed pensions or something once you get rolling with this. And most people just take that as, well, I'm investing for myself. You're not. You're investing in your business, which is you. And I have a lot of people that even after they are investing aren't claiming those.
Alan, the next question, and then maybe we'll jump into Q&A since we have about a half an hour, and I'm sure the questions will start rolling. What are some audit red flags? I know that when I do my taxes, I'm really afraid of maybe going too far and triggering an audit. What do you think are some deductions that may trigger an audit, and why agents should maybe fear them or maybe not fear them?
So first thing I'd try to say is taking away the fear of an audit. All an audit means is the IRS has decided to investigate you. They're not charging you with anything. They're not saying you did do something, which the average person in the US will be audited once in their life. For self-employed people, it's much more than that. Most audits happen on wealthier self-employed individuals. A lot of people get audited, doesn't mean they ever get charged with anything. It's the same on if your HOA or your cop side, hey, we want to see something you did just to make sure you're okay. So first of all, don't be that afraid of it, especially if you're working with a tax pro. We provide, and almost every tax pro provides, an audit protection on their tax preparation agreement. Or if something happens, they are going to represent you. 99% of the audits I've ever worked have been over literally in an hour. It's the IRS contacts us, like, hey, we think that you can't justify your car deduction. And I send them a lease agreement we have, or I send them a mileage log, and it's done. And that brings up one of the most common ones. Vehicles, home office expense, and then travel are the number one times that we see either an audit or a paper audit where you get a notice for taxes owed comes out. Which the easy way to avoid those things on the vehicles, mileage logs. Before 20 years ago, you had to do a paper log basically of every time you drove. Nowadays, it's super simple to download a mileage tracking app on your phone that just logs every time you drive. And then once a week, once a month, once a day, you just go in there and pencil which ones were business, which ones were personal. If you have that and you get audited and you can produce a log of 600 trips you took during the year, you're fine. Home office, where people get in trouble hugely, is when they're preparing their own taxes. There is one checkbox that will ruin everything. That it's where you pick if expenses were direct or indirect. Almost everyone's home office deduction is indirect. It's, hey, I have a house, but one room is my home office, meaning you only get a portion of all those expenses. If you hit direct, then on your tax return, it'll deduct the entirety of your mortgage, all of your property taxes, every single thing. So all of a sudden, you'll have someone who's an insurance salesman, makes $90,000 and is deducting $40,000 of home office expense. That's immediately going to red flag everyone. And it's one that if you're doing your own taxes on H&R, QuickBooks, something like that, you might not notice. You'd be like, oh yeah, of course, I'm paying those directly. It's a direct expense. And the last one is travel, especially when travel isn't justifiable. With insurance, you're actually one of the industries where you have more justification for going around and seeing clients, especially when you have clients who are a major part of your book of business. Where people get in trouble is they're, hey, you know what? I want to go to Vegas this year. I'm going to go there with 6 of my fellow agents. Now it's a business trip. Or I want to play golf. I'm not actually playing with clients. I'm going and I'm playing with 3 other agents I'm friends with. That's where people really get stuck, and especially based off proportions. If you make 200,000 of sales and you write off 2,000 a year of golf, it's not really going to stand out. It's 1% of your billings. Where people getting in trouble is trying to pay less than their fair share. And so they have 100K of revenue and they're trying to deduct 15K of travel, 15K of golf, and 10, 12K of home office. No one in insurance is going to be able to write off 50 or 60% of their income to 3 things. So it's really about being fair with what you're trying to pay.
So I would say don't fear it. Don't fear it. Don't be afraid. If they're legit, they're legit, and document. The one thing I do is meals. Okay. I write off a lot of meals. Alan, there's a little trick I learned, and I haven't been audited for meals, and hopefully I won't. But what are some tricks with meals if you're trying to write those off?
So, Mills, for instance, if you are eating with members of your workplace, it is technically a workplace meal, meaning it's deductible. Or anytime you eat with a client, with a prospective client. Where people get in trouble is, like, again, say you're an insurance agent, you're driving all over town to see people, you stop to have lunch. That is not a business meal. You'd be eating then if you were employed, self-employed, or just a guy in the street. So it's really that, and trying to have logs for these things. I know it can be tedious to put receipts together. Luis worked with our bookkeeper sometimes. It's as easy as I go out to eat, I snap a picture of my receipt. Or even simpler, pay things on credit cards, hopefully one business credit or debit card. And every month, every 2 months, hop on your QuickBooks and you just jot all the meals, which ones were business, which ones weren't. It's really the tracking part of it. But more so than that is, again, if you're going to attribute meals to be business, they have to be with a coworker, with your boss, with an employee, or with a customer/prospective customer.
And here's what I've done, guys. Every receipt, while I'm sitting there at the table, I'll put down who did I eat with and what did we talk about. And ink fades, guys. If you start showing all your receipts and they all have brand new ink because you wrote it out, a week before your audit, they're going to notice that. So it's one of those discipline things that you definitely must do is make sure every receipt comes in. I'll put down, okay, I'm sitting here with Alan. We're talking taxes. We're talking insurance, whatever. There's 5 things on a receipt. 3 of them are already printed. How much, where you were at, and the date. And then you just add who you were with and what did you guys talk about. Hand those to the auditor and like, there it is. It's that's just me. Well, cool. Alan, hey, you got some time here for some quick Q&As?
Of course. And quick one I'll ask, since you did bring up about the tracking the receipts, what I tell everyone is just make a Google Drive, because you can link that to your phone and have it automatic upload. You don't even have to organize it. When you get audited, it's not your business, it's not your job to organize those receipts for the auditor. You just download that file, hand it to them, and you're done. So quick one there.
I go old school, man. Old school. I put them in a little accordion file, and I have all my receipts in there, and they're by the month. And then every month, I wrap them with a rubber band, and then I stick them into my big box that has 12 months in it. So yeah, maybe I'm making that auditor's job easy. Maybe I should just throw them all in there and let them figure it out.
Not
Very, very cool. All right, guys.
Here.
So we're going to start. We're going to jump right into some Q&A from you all. Good questions. Okay, so we'll start off at the very top. Let's go okay. So from Ashley, can I donate 100% of my money to a 501c3 and not have to pay taxes?
Yeah, so 501c nonprofit. Can you donate 100? Yes. Will you get 100% written off? No. So when it comes to cash and cash-like contributions, you are limited to between 20 and 60% of your taxable income to deduct. Meaning if you make 100 and you donate 100, you're only going to write off 60. Specifically to stop people, specifically the hyper wealthy, from starting their own nonprofit, donating to themselves, and paying no taxes. That's the other big thing to watch out for is if you're going to donate to a nonprofit in large amounts, have it not be one that you are affiliated directly with or that is your family's. That's one of the biggest red flags for audits on those, especially because 501c3s have to report everything and everyone who donates to them. And they're public records. You can go on the IRS website right now and download all of those nonprofit statements. So be careful with that.
Great. All right, let's jump into question number 2 from Linda. The money that is moved into that tax account. So remember, guys, I mentioned my business practice, and I open up multiple accounts. But number 1 is you should have your operating account where your commissions come in, and maybe you pay some expenses from here, kind of money in, money out. But then you want to have another account, which I call it my tax account. And I move over a chunk of money. Every time I get a commission check, boom, I move over very, very disciplined. Now, Alan, that money that sits in that account, it'll be in there until my next quarterly payment is due. Can that money be invested in a high yield savings account or checking account?
Of course. And we normally recommend at least putting it in a high yields. Since sitting for 3 months, you can even put it in a dividend fund that's going to pay you a little bit higher. Like Luis, we do the same thing for you a lot of times. And instead of getting 3% of high yields, you can get 6, 7, 8% in a dividend fund. Since it's sitting for 3 months, you have quite a bit of time security. One thing I'll add to that, I always recommend if you're going to have that tax savings account, don't have it in a business account. Because remember, when you're self-employed, you're technically paying your personal taxes, not the businesses. So have that high yield savings in your name, not the business name, would be the only thing I'd add to that. But
All right,
yes,
now
for high yield, something like that.
I know there's an agent out there. Well, you know what I'm going to do? If I've got 20K in there, I'm going to go invest it in stocks. What are your thoughts on that? Just with the potential, I can make more money in stocks than the dividend amount.
Which again, we love investing in the stock market. When you have 3 months, every 3 months to pay, you're taking a lot of risk if you're investing in the stock market just because of volatility. If you get unlucky and that 15th hits when you have to pay those taxes, the stock market dipped 4, 5, 6%, you might either not have enough or you're having to pony up extra cash to pay for it. So I would personally never risk that. I'd rather have, like I said, a high yields or a dividend fund that's paying dividends out every month and is super stable.
Perfect. Great. From Franco, and I'll answer this one. Um, but are commission advances real income? Okay,
Yes.
so go ahead. I'll let you go ahead and I'll throw in my 2 cents.
So yes, where it can get tricky is obviously when it's an advance, there's the possibility that you have to pay it back. Which what this basically happens is when you get that money in, it counts as income. And if you then have to pay it back, it's an expense, a reimbursement. So that's a really tough line because where you can get into a lot of trouble with this is you might have a commission that pays out to you in December, and then in January, you have to give it back. So that's where you do kind of sometimes have to foot the bill yourself, where it's you have it in December, you're paying taxes for that money that you made, and then next year you're gonna have a deduction for the paying back or refunding of that commission.
And what Alan is referring to on a payback, and I put a comment on here where I put down, it's more of a loan. Okay. When you have to pay back advances is if the customer that you received that commission on cancels his policy. So if you receive, just to make the math simple, an entire year of commissions and it's $1,200, which means it's $100 a month. And that you let's just say you receive the full $1,200 in January. And the insured cancels in July. Well, he only stayed on the books for 6 months. Now that means the insurance company wants the last 6 months of commissions they advanced you that are not earned. They are charged backable. So now you have $600 that you owe. Well, you go sell another policy and they kind of sometimes will wash off. If you don't sell another policy, the insurance company wants their money. And it's not a good thing to owe an insurance company money because if you don't get it to them in a timely fashion, they will cancel your contract. Okay, not a good thing. So, me personally, and I know sometimes newer agents need the cash flow, but try to go as earned. You can request it as earned commissions. All that means, you're not making one penny less, but you're making it every single month that insured pays their premium, you make your commission. So I always tell agents, when you get as earned money, you could spend it that next month and not worry. When you get advanced commission money, you're like this, please don't cancel. Please don't. I mean, you are hoping that insured doesn't cancel their policy. So those are just my thoughts. I've learned to live on as earned money. And it takes a little getting used to, but I would highly recommend it. All right. From Manuel, what percentage is the penalty for paying at the end of the year versus paying quarterlies?
So this is where it does get slightly complicated. Technically, the late payment penalty is between 0.5 and 5% of the amount owed per month late. It's 5% when it's for month owed late after the April 15th deadline. Everything before that, it's 0.5. It can double to 1 if the IRS has formally sent you a notice to levy your assets. To simplify it, you have those quarterly payments. Say you made 100 for the year, so 25 per quarter. They're going to say you owe taxes for 25K of income in April, in June, in October, and in January. If you wait till the April deadline, you're 3 months late for January, 6 months for the previous, 9 for the one before, and a year late for the first one. So you're going to owe proportions to those 3. The max it can be total is 25%. So worst case scenario, you wait till October to pay. You're going to owe roughly 25% of the amount owed. So say you owed $1,000 in taxes, you're going to owe $250. And then added onto that is 8% interest that the IRS charges on any balance you hold with the IRS. That number changes every year. It's up to 8% now.
So technically, if I'm doing my numbers right, that's 33%. So if you're withholding that money because you think you can make more in the market or however you're going to play with it, you're going to have to beat 33%.
Basically, which is why we tell people just pay it ahead of time.
Gotcha. That makes it easy. If you have some kind of stock market secret and you can make more than 33%, knock yourself out. But if you can't, which is the majority of the rest of the world, then no, pay your quarterly taxes. Get it over with. Don't give the man any reason to come after you. All right. Very good question, Manuel. Let's go to Ronnie. Okay. So I've been using TurboTax since I am a W-2 and a 1099er. But since doing insurance for 2 years now, how long do I have to find a firm to help me with my taxes? So when is it a good time to hire somebody like you, Alan?
So I would recommend people, if you're going to have someone do your taxes for 2025 tax year, you need to find them the year before. Because just preparing your taxes is only half the battle, as Luis can tell you. The main thing is the strategy, implementing during the year all the things we want to do to save you money. If you show up to give me your taxes right now for last year, I can give you a good return and I can tell you what things you can and can't do, but I can't go back in time and find you new things to expense on or deduct or new vehicles to put into. So really, I would say right now is when you want to be planning for next year's tax time. As far as deadlines, most firms are not going to take on a new client after March 1st to March 15th to file you by the deadline. That's my deadline, is March 15th. Anyone who comes in after that, I will extend your taxes and do them afterwards. Because when you have hundreds of returns due, you just can't finish that many people and onboard a new client in a month's time. And almost every firm in the US is going to hold you to those deadlines.
So I would say, Alan, the only thing, if I'm coming to you now, I'm working on my 2025 taxes, and I'm like, Alan, what can I do to minimize? Really, the only thing I can think is investments,
Exactly.
an IRA. Invest before you file the return.
That's really the last one you're going to have, which is the other great part about the investment accounts. And it's really the only one that allows you the flexibility of choosing whether or not to do it after the fact.
Okay.
And it's money you're back to yourself too. Sorry.
Here's the deal. I've been in the business 25 years. Okay. I visit with these guys probably a little too much, but I go because that retirement little bell, the light at the end of the tunnel is right there. Okay. But it's taken that many years to get there. So my advice to you guys as an insurance agent is pay yourself first. Okay. Go pay your taxes. You pay the man first, I guess. Set that money aside, but then you can potentially minimize how much you pay them by investing in yourself. Opening an account. When I say potentially, maybe you end up doing a Roth. Well, the Roth is not going to save you any taxes, but it is a beautiful thing when you pull the money out and you don't have to pay taxes on it. So 100%, guys, pay yourself first, pay the man, and then whatever's left over, well, that's what you live on. And that's it. That's the way you do it. You live on what's left over. You know, it's a great way to run a business if you can operate like that. Okay, really good question. All right, let's go to Rhonda. Rhonda, will the sign on my car marketing allow me to use business marketing for 100% of the car deduction when asked how much it's used for personal versus business?
Okay. So there you're going to mix two different deductions. When you have the car and you put your sign on it, a vinyl sign, you're going to A, get to deduct whatever the cost of that sign was. B, your mileage when you drive it for work. Where it then mixes is you are now basically having a moving billboard, which the way it works most times, most people, when they have a sign like that on their car, is when someone's paying them to have that vinyl wrapping on their car. And they will pay them an appropriate cost for that. So the way you'll be able to deduct that is one of two ways. Either you're going to have to tie what the relative cost of that would be and deduct that. So if you do the research and you can show that the average price to have someone else put this on their car and drive around for you is $600 a month, $500 a month, whatever it is, you'd be able to deduct that cost. Or B, a portion of mileage driven, which for generally everything of that style, it'd be 50%. So for you, when you drive for an actual business event, going and seeing a client, going to a meeting, you get, right, for this year, 70 cents on a mile of deduction. For this, you would get into 35 added onto that for all extra driving. You drive kids to school, you drive to a vacation, whatever you're doing, you would get an additional 35 cents on that.
So one thing I've done, if you own multiple cars, well, one of them is really my business car, one's my personal, and yeah, I guess we'd write off the business 100%.
Yep. It's where you can have both kind of things, especially if you have a lease is one of the best ways to do that, which at least we discussed this with you, depending on which cars you buy. You could have a leased vehicle under the business's name, where that one you deduct 100% of the lease payment. And then additionally, if you also drive your personal vehicle sometimes for these, you deduct the mileage on that.
So I lease, I'm in Arabian, I'm leasing my wife's vehicle as in a lease best, and she's an agent too with me. Guys, it's, you know, that's where you talk to a tax guy. Before we got into these two new vehicles, I was like, Alan, what do we do here, man? Do we just buy or do we lease? And his advice was to lease, and that's what we did. That's where the value comes in having a tax strategist, is they know your picture and they know what's going to be the best thing for you. All right, let's go to Deborah. Deborah, what if you are on an ACA plan with your family? Can that be deductible as the insurance?
Yes, a portion is what it's going to work. Whenever you have a group plan, just like if you had a phone plan with 4 lines on it, you deduct your business portion, which would be a fourth of it. It'll be the same thing here, unless your policy also discloses what percentage is each person. Because you might have one person in that household that is a higher cost than the other. You'll deduct whatever your proportionate cost is. Caveat to that is if you employ your family under your business, that would also be a cost. So for instance, you could have it where your wife works, like Luis, his wife is one of his agents technically, and his kids could be at some point one of his agents. Therefore, the entire policy would be deductible. Portion as self-employed health insurance and the other portion as an employee health insurance.
And guys, all my kids work for me. They're on payroll. Those little suckers are going to be multimillionaires. They don't receive the money, but what they get paid goes into the Roth IRAs. So, yeah, what was really neat here is they finally said, quit putting money in there. You don't need to put money into their account. They're going to be multimillionaires when they're 30. Yeah, what a great gift I'm going to give my kids. I wish my parents would have done that. Probably because they didn't know any better. All right, let's continue.
Huge. That's
Yeah, knowing. Oh, it's so good. So, from Madish, at my previous employer, he was audited and they give him additional money back. What do you think about that one, Alan?
It's more common than you would think. Because one thing that audit does provide for you is now a venue to present new information. So we'll have a lot of times where we do someone's taxes and they come back 4 months after tax season, like, hey, I found this big bill I forgot to put in when I gave it to you. And I tell them, hey, we can amend this. It's going to look really bad. Because it's really high risk to add a big expense 3 months after the fact. But if you get audited on that year and you're like, hey, now's the time to show this, it's more common than you would think. It's about 50-50 actually, when people end up actually getting more money back.
Very cool. All right, let's keep going here. Can you explain paying your kids and getting a tax deduction? I have an 11-year-old and a 13-year-old, and they've been my advertising managers. Yes, because those little suckers, they know social media.
So the biggest thing here is being fair and reasonable. That's the term the IRS uses. Which the biggest thing with kids is, depending on their age, what things they can reasonably be doing and for how long they can be doing it. So the easy way to get around this is by putting an hourly term on it. If they're going to be getting paid $20 an hour, you can't say that your 12-year-old that goes to school for 8 hours a day is working 10-hour days at the office. What you can say is, hey, he comes to work with me every day after school for 2 or 3 hours. On Saturdays, he comes for another 10. That's 12, that's 20 hours a week. Every month I pay him the proportionate hourly fee. Because the IRS has no say over the quality of their work. You can have a bad employee, that's not an issue. And then as they get older and older, you get more things you can attribute. Like right now, 11 and 13, they don't drive. The second they can drive, you can justify employing them for moving things around, taking things places. You can deduct part of their vehicle, things like that. So it's really just being fair for the stage of life they're in. You don't want to have a 3-year-old and try to pay him $50,000. That's going to be a red flag. Most people, if you have a teenager, the second they're a teenager, you could start paying them 15 to 25, 30,000 a year very reasonably.
Yeah, I'll tell you, I'm due 12. I do 12,000 for my young one. I do, which is 1,000 a month. I do 12 for my other one, and I think I do 1,400 for my 17-year-old.
Yeah.
And yeah, move the money into their account. They do their thing, and then I pay their Roth IRAs, and then the rest of the money is really theirs to kind of spend. But I don't tell them about it. That's the key. I don't want these guys to be putting money out. Not when they're 18, when they can own these accounts. Okay, we got a couple more questions here, Neil. I'm sorry. This is coming from Neil. What if you have two businesses? And this is on the Q&A section. What if you have two businesses? For example, 70K in insurance and 30K from another business that he's running. Is an S-Corp a valid option?
Again, it's going to depend on the size of them. And that's when you do start mixing liability with tax. If I have two businesses that make 50 or 60 grand, neither of them by themselves is going to have a huge benefit for being an S-Corp. Together, they might. So that's when you do have to look at the risk level and be like, is it worth for the tax savings putting these two companies together under one S-Corp? The risk you have there is that the clients on one side can now make you liable for the other business as well. For a lot of people, we end up having one S-Corp and something Schedule C. Where you have someone like Luis is a perfect example, where he has the insurance, he has a teaching business, and the photography business. Say we had S-Corps for the teaching and the insurance. The photography, it's going to be a small portion. I'm probably not going to tell him to make an S-Corp for that. I'll probably say, hey, that will do on Schedule C. It's a small thing. Let's add it on. So there I would suggest talking with an attorney to see if the two different businesses have very different liability profiles. But if they don't, and they're not going to be a risk, you can put them together under one S-Corp with multiple lines of business.
Great. Hope that made sense to you, Neil, because that was really above me. So that's where you hire the pro. This question was already answered, but I still want to ask it for the rest of the agents on here. Is if you're working from home, which I know a lot of agents do, and you claim the square footage of the space that you use. So if you have a 2,000 square foot space, but you use one of your rooms, which is maybe 200 square feet of space. So 200 of 2,000, that's 10%. So you would be able to write off 10% of all the house expenses?
Yes. So utilities, mortgage or rent, property taxes, and the big one is repairs. When you have to repair it, just like you were repairing your office, your roof comes off, your foundation, something like that, painting, maintenance. Where you have to draw the line is if I am buying furniture for another room, do not try to put that in. That's going to be a red flag. because that's more of a direct business type of expense. Office furniture. If you're buying office furniture for the actual room, you deduct 100% of that, not just 10%. But if you're buying beds for your kids, living room furniture, something for the kitchen, you did not add that in. That's really where you draw the line. But everything else goes on there. Internet, phone bill, landscaping, you have pest control, everything like that that is a expense of the home, because all of those are proportionately for that room.
Awesome. Awesome. Cool. And then, Alan, I am parked. I'm not at my office right now. I'm parked right in front of the VA. I got an appointment here in 10 minutes. Want to finish off with this final. Well, you know what? I'm going to ask Ronnie's question. I think this is a quickie, and then I'll jump into mine. Is paying a child 100% tax deductible?
Yes, every employee you pay, whether they're a child or whoever, is 100%, not deduction, it's an expense is really what it is. Your business expenses that payroll or that 1099 that you pay them.
So just to give you an idea, so I pay my oldest 1,400 a month. That's what, 14,000. Let's just say it's 17,000 a year. So I get to write off 17,000. I don't pay taxes on because I paid my employee, which was my child. Now my child will file a tax return at that 17,000, but remember he has a standard deduction. Is that right, Alan?
Yep, 15,000. He's going to pay
So
taxes on 2.
So technically we got away with 15K that nobody had to pay taxes on. Beautiful thing there. Ronnie, I hope that answers your question there. And then we'll finish off with this with this, Alan. And guys, I've been posting my email on here. One thing I want to make sure is I have a new school platform called ACA and Medicare Mastery. And for all my agents that are on here, I'm charging to be part of this school, but not you guys. So do me a favor and send me your email. I posted my email. Just say, Luis, add me to school. I'll send you a personal invite, which means you don't pay. Now, who pays? People that pay are the ones that are not part of my organization. So if you're part of my team, you have contracts with me, then just hop in or email me and I will send you the link. We'll finish off with this one, quickie here. How about if they're over 18? I don't think it matters, right? The age?
Age does not matter. Again, when they're younger is when it does matter for how much you can attribute to them. When they're older, I have seen people who have very large businesses where their 30 and 40-year-old children are on their payroll. And the main reason being exactly what Luis was talking about, where that child gets a standard deduction and then pays at a lower tax rate. If you have a kid who makes, even if they are working a different job and make 20, 30, 40K a year, you can pay them another 30. They pay it at their low tax bracket instead of you paying at 37%. And you can keep on there forever. Like for instance, I personally, on one of my self-employed businesses, pay my sister. My sister's 29, lives out of the country, has no other attributable US income. So it means like if I'm going to give her money anyways, I deduct it on taxes. She's going to have that for the rest of her life.
All right. I don't want to forget this, Alan, when I ask the question, but would you post your best contact information? If somebody wants to work with Alan and you want to hire, and guys, I only bring people on here that I know and I work with and I trust. So you're getting my endorsement from Alan. He handles my stuff. So if you want to work with him, he'll be in the comments to be posting his contact information. Connect with him. And again, guys, just because I know him and he handles my stuff, I don't know anything about the rest of his clients. So this will be directly between you and him. I'm not involved in your all's connection if you guys decide to talk. But we'll finish off with this last question, Alan. So for bookkeeping, accounting, what's the best software? If you're doing this old school with spreadsheets or maybe jotting your notes down in a binder, whatever, but man, we need to get with the times. What is the best software that you recommend?
QuickBooks and the entire Intuit platform is what I suggest for everyone, especially for people like insurance salesmen who are on the go quite a bit. The fact that you have QuickBooks online as well as desktop and on the phone. Because especially now with the AI they're putting out, you can be on the phone, take a picture of a receipt, and it adds it to your bookkeeping for you. And it auto logs a lot of things. So if you're going to be DIYing it, or like Luis, who partners with our bookkeeper, he has his own QuickBooks. And it can link to us. Our bookkeeper can revise things for him. And it can link to my tax software too. So it's for me, it's the best integration, and it's actually one of the lowest costs relative to the market.
So, guys, yeah, I like QuickBooks. It's an expense. Yeah, it is what it is. But you know what? We got to do things right. And hopefully, by you having QuickBooks and allocating all of your expenses, I go in there every day. My morning routine, I hop in, I update, I get my new expenses, and I categorize them. Instead of doing it monthly, I do it every single day just to make sure, this expense, I remember I took it yesterday, so I know it's fresh on my mind. Was it a business meal? Was it a private meal? Or what was this bill or that bill? And everything is still fresh versus a month later where I'm not going to have a clue what happened. And QuickBooks, that whatever you're going to pay, 60 bucks, whatever it is tax deductible. So again, it's a business expense. Liz shared a comment here. Thank you for sharing, Liz. Everlance tracks mileage. I even think QuickBooks tracks mileage, doesn't it?
They have an option, yeah. So you have
Yeah.
to share permissions on your phone, and they can track that as well.
So I guess you'd hit the on button and say, okay, I'm going to see a client, and it starts your mileage there. So different ways to do this. Thank you, Liz, for sharing that. All right, guys. I hope by listening to Alan, you've gotten a little help in prepping your taxes. Maybe a little too late for 2025, but it's definitely not late for 2026. Alan and his team at Taurus Advisory Group, they do everything for me, guys. These are my tax people. They're my finance, my investment people. They even handle my legal stuff, all the LOCs that I've created for my properties and for my businesses. They've put that together, so it's kind of a all-in-one kind of firm. But if you just want to talk taxes with Alan, connect with him, and you've got my 100% endorsement of working with him. If you guys missed some of the training, I will be posting it in school. So once I get the recording updated, give me till tomorrow, maybe tonight, I will get it updated, and you can watch the recording of this, and we should be good. All right. Hey, Alan, man, I appreciate your time. Thank you for being on here, man.
Thank you. And I just want to add for everyone, but you have my contact info there in the chat. Any of you that contact in, just say you're coming from Luis's side of things. Anyone who wants to come in, I will give y'all a free consult as an introductory meeting where we can discuss what things I think you could and could not take from us as services. And if you choose to move forward, you choose to move forward from there.
Even better, guys. You can't be that. A free little consult. Hey, present your scenario and see if working with a team at Taurus Financial and Allen would be a great fit for you. I wish I would have known or had an idea that there were people like that I could work with when I started back in the day, and maybe I'd have more money in my account. Who knows? But take advantage of them. All right, Alan, I got to run. Thank you all for being on today. We'll see you tomorrow for ACA 101 and then Thursday for Medicare 101. And soon, I think late March, guys, just an FYI, we will be bringing in the attorney from this advisory group to talk about legal structures. Yes, you want to set yourself up an LLC, an S-Corp. No, that's a tax structure. An LLC or whatever other legal entities they are that might work for you. She'll be the one to help you with it or advise you. So I will be bringing her on this call here in a couple of weeks to y'all. All right, guys. Thanks again. We'll see you all next time.